Investing for beginners? Stocks versus bonds, mutual funds, ETFs, and setting realistic goals. New to investing? Learn the basics of stocks, bonds, mutual funds, and ETFs, plus how to set achievable financial goals, a beginner-friendly guide to building your investment foundation. Investing can feel intimidating when you're just starting, but it doesn't have to be. Whether you're curious about the difference between stocks and bonds, or wondering if ETFs or mutual funds are right for you, this guide breaks down the essentials. You'll also learn how to set realistic goals that align with your timeline and risk tolerance, helping you build a smarter, more resilient portfolio. 1. Understanding the core investment types. Stocks. Ownership with growth potential. When you buy stocks, you're acquiring a small piece of a company. The value of stocks can rise, capital appreciation, or fall based on company performance and market trends. They offer higher growth potential but also come with greater volatility. Bonds, stability, and income. Bonds are like loans to governments or corporations. In return, investors receive regular interest payments and the return of the principal at maturity. Bonds typically offer lower risk, but also lower returns. In today's market, high interest rates make bonds especially appealing for conservative investors. Mutual funds. Diversified management. Mutual funds pool money from many investors to purchase a variety of securities, stocks, bonds, or both. Managed by professionals, these funds offer easy access to diversification, but often come with management fees. Index mutual funds being passively managed tend to outperform actively managed ones over the long term thanks to lower costs. ETFs, flexible, lower cost, diversification. ETFs, and especially index ETFs, offer similar diversification benefits as mutual funds, but trade like stocks on exchanges. They tend to have lower fees and greater tax efficiency, making them a smart choice for many beginners. 2. Why diversification matters. Diversifying spreading investments across asset classes and regions reduces risk. Think of it like building a house with multiple materials. If one fails, the others still hold. Proper asset allocation helps smooth returns over time. Recent commentary highlights the importance of global diversification, including international equity exposure, and a balanced stock-bond mix to mitigate market volatility and capture growth opportunities abroad. Bonds, notably, remain essential for long-term stability even in today's dynamic markets. 3. Setting realistic goals and aligning investments. Define your financial goals and timeline. Are you investing for short-term needs, under 5 years, intermediate plans, 5-10 years, or long-term growth, 10+ years? Short-term goals. Stick with low-risk tools like high-yield savings accounts or money market funds. Long-term goals. Lean more heavily into stocks, ETFs, and mutual funds for growth potential. Understand your risk tolerance. How comfortable are you with market swings? Younger investors often can tolerate more volatility, but starting small and growing steadily is key. The advice to have it all but not at once reflects the balance between enjoying life now and planning for the future. Stick to a long-term buy and hold strategy. Trying to time the market rarely works. Instead, focus on a long-term approach with broad diversification and regular investing, especially through robo-advisors or low-cost index funds. 4. Smart investing tips for beginners. Start small and simple. Begin with low-cost index ETFs or mutual funds that track broad markets like the S&P 500. Avoid emotional investing. Trust long-term strategies rather than chasing trends. Market research shows that performance differences often result from poor investor behavior, not fund quality. Consider trying individual stocks, small allocations. Industry insiders suggest dedicating a small slice, for example, 5-10%, to direct stock investing, not for returns, but for learning and engagement. Regular rebalancing. Periodically check and adjust your portfolio to maintain your chosen asset allocation. Starting your investment journey isn't about finding a perfect shortcut. It's about understanding the tools, building a diversified portfolio, and committing to long-term consistency. By knowing the distinctions between stocks, bonds, ETFs, and mutual funds, and aligning them with your goals and risk comfort, you're setting up smart financial growth with confidence. Find lessons like this for education after the bell rings at learnmoreuniversity.com.